Hello everyone, welcome to another episode of our show. Today it's me, Jean Galea, accompanied by my guest, Gustas from InRento. We'll be talking about this new platform and how it works, what are the risks, what level of risk we are taking when we invest in rental properties, which is their chosen target market for investments. And I found it to be a very informative conversation with Gustas, who I think is a brilliant guy. I've known him for around 2 years now, based on his previous experience with Evo Estate, which is another platform that I like. And as always, it's been a great conversation with him. And I hope that you will enjoy this conversation. And I encourage you to follow that up by checking out InRento.com. Without further ado, let's get into this chat I had with Gustas. Hi Gustas, welcome back to the show, and it's the second time you're here with us. You're one of the few guests who have been with us twice, and for a good reason. You're involved with a new platform. We had gotten you to speak around a year and a half back to speak about Evo Estate, and this time we're going to be speaking about InRento, which, as I'm aware, you've just got a good funding round, a seed round, which I'm sure you'll be talking about. So again, welcome to the show, and let's do another intro as it's been quite a while for the people who might not know you.
Hi, John. Thank you for having me. It's always great to be on your show. Let me introduce myself. So my name is Gustas. I'm a serial entrepreneur. I have founded a few fintech companies. One of them is quite relatively well-known in crowdfunding space called Evo Estate. So for those who don't know, I'll briefly introduce that. Basically, Evo Estate is a single and the largest real estate crowdfunding aggregator where basically investors can sign up and invest from a single account all over Europe. So Evo Estate today probably serves something like 5,000 investors. We have helped to finance deals in 18 countries. And we are, creating diversification for each investor bigger and bigger every day. While I was actually running Evo Estate, I came to a very interesting conclusion. Basically, the crowdfunding and the P2P in Europe, everyone is focusing on the high risk investments. Everyone wants highest return, highest risk. And I mean, in general, that's okay. But for a lot of people and the general population, crowdfunding or P2P investments can seem quite high level of risk. Even if we consider just the general industries like real estate development or consumer credit, it's just a high risk product. What I noticed was that in Europe, I would say no one isn't actually doing lower risk crowdfunding products. And I figured that, maybe this is a market where, we could tap in and create lowest risk environment platform in Europe. And that's how InRento came up. So InRento is Europe's, to be very precise, Eurozone's, the continental Europe's first licensed buy-to-let crowdfunding platform. So essentially what we do, we'll help people to invest in rental real estate without requiring these really large amounts to acquire it, and then naturally without the hassle of managing and maintaining them. So we are solving these two critical issues. And so far, from returns perspective, we've been very competitive, even compared to a lot of development platforms.
Okay, let me just challenge you on this aspect of risk. So I've basically probably seen most platforms, and I've invested in several of these platforms in Europe and even the UK. I would include the UK as well. And I've seen kind of the whole range of risk. I would perhaps say that I would not necessarily agree that InRento is the only one, but I would like you to go a bit deeper in why you think InRento falls on the low risk side of the scale. So let's paint the picture of this whole scale of risk that we've been talking about. Like on the high risk side, what can we find? Middle, what can we find? And low risk. Obviously, everything is risky, but there are degrees of risk.
Yeah, of course. naturally, I have to put a disclaimer here that naturally I'm biased.
Yes.
That comes with a disclaimer. But
that's why I'm here to challenge you on the other side for the benefit of the listeners.
all right. So I think that the highest risk generally are unsecured loans. So basically, unsecured real estate loans, sometimes they are called as variable interest. These loans are where you can get the highest return, but at the same time, you have very few guarantees. Then if we go lower, I would say that the most common one and the one who sits in the middle is development finance loans, which basically are fixed interest loans. They are backed by real estate collateral, and they have LTVs, something 70%, 65%. Then I would say that the one who's lower than this one are the classic buy-to-lets. So basically, the ones that you see in UK platforms or you see in some unregulated platforms in Europe as well, is where they buy the asset, they offer it to the investors, invest, and then they are administrating the asset and distributing the interest. And then I would say that I would like to consider that we are below them for one simple reason. Although we provide very similar project as it is buy-to-let, but in our case, we have external borrower. And that external borrower is not only managing the asset, but also taking on, the financial responsibility and, obligations that this person needs to fulfill to the investors. So what I'm saying by that, different to those platforms, what we're trying to do is we want to have a combination of both, meaning a cash flow investment and at the same time, a security for the investors. So meaning that even though the asset is acquired and it's fully rented out, and there's not going to be some development or an element which will increase the value, the asset also has LTVs, and we are targeting 80% LTVs. Usually, some projects are riskier; they bring higher returns. Some projects are more conservative, lower returns, higher security. So I think these are two elements which makes us position ourselves as the lower interest, I said it right. I said I'm incorrect, but in the same time, right, that lower interest, but at the same time, lower risk platform.
Okay. And for those who are totally new, let's get into what LTV means. And more importantly, I think, because you mentioned on the high risk side, those loans where some platforms are actually kind of inventing the value because it's a projected value of what the development will be at the end of the project, if that ever gets finished. But I think the LTV is an important thing to talk about.
LTV is a metric, which means loan to value ratio, which basically indicates the value of the asset versus the amount of loan. And I think this is where it also gets interesting if we dig really deep inside the real estate crowdfunding platforms and the market as a full. As I told you initially, I have experience with working probably with 20 real estate crowdfunding platforms. I analyze their finances, business models, and there's a big difference between platforms who measure only value, basically asset value to loan, and calculates LTV this way. And then there are platforms who go a little bit beyond and they measure the price. So basically, you can see in the internet, in forums or other platforms that basically this asset was bought, for 50,000, then, it's somehow valued at 200,000. So basically, when we analyze risk and we look at things, we look not only, at this valuation of the asset, but we also look into actual acquisition price, because in our case, we are always trying to finance deals at acquisition with unrelated parties. This way, the price is dependent by the market, but then we also have value as an indication for risk management.
Okay. I'm sorry, I'm going to be a bit boring here, but I think it's very important to make it clear for everyone listening. If we were to talk about the spectrum that we're talking about, but as if it were a person doing the real estate investment on his own, forget the platforms for now. Could we give the listeners some examples of these three different models that we mentioned, how to get involved with real estate? I guess the riskiest part that you mentioned would be buying a parcel of land, maybe in some area which is targeted for having a big growth potential, building up some apartment complex, and then hoping that in the meantime the area will actually grow and market demand. The place that you built was good and there's demand for it, etc., etc. That would be the highest risk. Am I correct?
I would say yes, but I would say that the highest risk comes not because you're building something new in a known area, but mainly because if you were to build this asset and you would ask me for money, and I would say, yeah, I'm giving you the money, but I don't really care if you give me something back in terms of security. And this way, you have more freedom in order, when to sell, for what price to sell, and you're basically, you have a very high freedom of choice. So for me, as the lender, this is probably not the most safest element. But at the same time, my returns are not capped, meaning that if you make good projects, you make good returns. I'm gonna earn good returns as well.
Yeah, I agree. And we've seen a lot of examples of this kind of risky investments on platforms that have either gone bust or platforms that are still running. I mentioned Housers because I'm in Spain and I've seen this kind of investment, and I've seen how many of them failed eventually. And again, I saw someone mention some of these investments in Lithuania, I think it was. They were building some fancy apartments next to the seaside. Again, you're not only betting on the development itself, but on the area, on whether it will develop. And as you said, the borrower has a lot of freedom, maybe too much freedom. So we're agreed on that. What about the mid-risk portion that we mentioned? How would it be the analogy of someone doing it on his own? What would he be doing in that case?
So, you're building a house, or, you bought already an existing house and you want to refurbish. And instead of, coming to me, I may have, higher risk appetite. So I give you, unsecured loan. And this way, we did another deal. But if you were to do this one and you see that your project, it qualifies for good terms financing at the bank, so you just go there and you ask for fixed interest loans. And that's it, For the creditor, the good thing is that he knows what he's supposed to get back. This is the amount, and he has collateral. Your project doesn't work out. He takes over the asset, sells it, and then he covers your obligations. But at the same time, there's some downside to it, that your returns are capped. So meaning, you can make a 200% returns, and but I'm, as a bank, I will just get my fixed interest, and that's it. I'm not saying that one investment type or another is better or worse. It's just different risk elements, and it's a different type of investor. Some of you cannot. How to say, if someone wants to earn above 15%, so probably it's the best way for him is to just invest in unsecured loans. This way he can maximize those returns. With fixed interest loans, with collateral, most likely you will not achieve that. But again, it's not like it also, there's no guarantee that you will make this money because it's unsecured. So you have to already calculate how many defaults you will have.
I agree. And I'm asking all these questions because I know I've made the mistake when I started with real estate of not understanding these different risk profiles and just, taking risks which I shouldn't have. So I want to make sure that people who are getting in now understand the risk spectrum. And then obviously one can understand his own risk tolerance and invest appropriately. So the kind of mid-level risk that we're talking about would be kind of what people say when they do house flipping. Would that be similar to what we're talking about here, where they buy a property, refurbish it, hope to get it on the market within 8 months, sell for 20% profit?
Yes, I would say yes. But I would also include, developments. It all depends on the deal structure and, the securities the borrower provides the lender.
All right. And then let's move on to the lower risk spectrum. And let's say again, single investor, what would he be doing in the traditional world?
This investor would do the most common investment type, most likely in Europe, that everyone has been doing for hundreds of years, is buying a rental property, just renting out, dealing with tenant, collecting monthly rent, and later either selling or keeping it, or renovating and keeping it for the future. I think that this sort of investment type needs no introductions. We know everyone has, a friend, an acquaintance, or himself, or a family member who does it. That's the most understandable, the most common way to invest in Europe.
Yes, and I would say most people even buy their properties based on this rationalism. I'm gonna buy a property, live in it, okay, instead of rent it out. Probably it will increase in value if I need to sell it in the future. Everybody is happy. Low risk.
Yep.
I would debate whether it will always work, but that's the rationale.
Yeah, that's the rationale, and I think it not always works. Like the market is generally dynamic. Like if we consider that what has been working in the past, it doesn't mean it will work forever in the future. But generally, that's exactly the reason why we are having the borrower in our model, and that's why we structure it as a financing product, not an equity product. And what I mean by that you have LTV. So we just previously explained. So let's take an example of a project we had before. So basically, we had 80% LTV, something like 108,000 euros to finance, and the value is 135,000. So let's consider that, all right, the market doesn't go up.
By the way, for some context, because we didn't mention, my mistake, these properties that we're talking about so far are in Lithuania, and these 3 projects that I can see on the website are in Vilnius, the 3 of them. And we're talking at the moment about one particular project which people can see on the website. It's a modern office at Aetis Street 10, Vilnius.
Future Street.
Is that what
Street
it means?
Of the future. Yeah, it means the
Cool.
Street of the future. It doesn't look that much the Street of the future, but at least it's the name of it.
Nice. How do you pronounce it?
ITTS.
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 Okay.
Yeah, ITTS. Got it.
So yeah, sorry, I stopped you there. I just wanted to give some context.
Yeah. So basically, this particular project, it has LTV of 80%. So what it means in reality, it was the loan amount was 108,000. And now, if I'm not mistaken, the value of the asset by independent valuer was 135,000. What it means is that, if we have, let's consider the market doesn't go well, right? Let's say the market decreased by 10% the value. So, if we take this hypothetical example that, today the asset value is 135,000 and it goes 10% down. So, all right, we lose 13,000 of the price. We get 120 something thousand price. And then, even if we sell by this price, the investors get capital growth in this particular case. So this is exactly the case, how we try to secure the projects, and there's always some way, some place in case the project would, decrease in value.
All right. And I see here that there are 2 properties which were commercial, and there's another one which is residential. Do you have a particular focus, or do you plan to do both?
We would like to have all, like basically on commercial and residential and short-term vacational rentals. But, like today, the market is really interesting of real estate, because what we have today in Lithuania, and we're seeing this across all Europe, the real estate prices are increasing. In some cases, it just makes no sense to buy because, you have a very low rental yield, 3-4%. I mean, in Barcelona, 4% is fine, but not in Lithuania. Basically, in Barcelona, a good rental yield for a residential asset is 4%. I mean, if you're going to 5%, it's pretty high. But I'm talking about like real Barcelona, not some suburbs, some interesting area, real Barcelona. And main reason for that is because there's a lot of money. People are willing to buy properties in Barcelona. They have really high prices. But the rent of the asset just cannot go higher because the population of Barcelona is just not earning enough to cover that rent. So in this case, the value is increasing because a lot of people are buying, banks are financing the property, and Barcelona generally is it's one of those markets in Europe where people just like to park their money. It's like a saying when, you have a lot of money, you don't know where to put it, and you want to put it somewhere safe, but also, maybe it would generate some income, but you're not looking for really high returns. Barcelona is one of your options. So basically 4% yield in Barcelona, that's fine.
As an investor, if I buy an apartment here, I'm going to be hoping for the 4% yield every year, but I'm also banking on an increase in the value of the property if I sell in 10 years or 5 years.
Yeah.
That's the idea.
But like if we analyze like Barcelona market in particular, you have those acquisition taxes. I think it's 11.5% or something close to it in Barcelona. So like you need your property to grow in value pretty high that you also, cover all those taxes. So it depends. This main reason why these taxes exist is, to prevent the speculation and, Spanish real estate market with flipping. So this is what you have in Spain. And then if we look at Lithuania, I would say that 6% rental yield from residential assets, so housing, is a good result. But then again, we have to analyze each district. Like Vilnius city center, the old town, I think the average return is 4.5%. Same as Barcelona, really high prices compared to low rents. Like it makes more sense to rent an apartment there, but the capital growth is there. Like the price of the assets are growing or have been growing for a very long time. So this is what's happening generally across all Europe, that we are seeing, the rental yield decreases because all the prices of the assets are growing.
But just to dig down for people, let me play the stupid investor. Why is it okay to earn 4% in Barcelona and not okay to earn 4% in Lithuania?
It depends. Like in Lithuania also, there are some places where 4% makes sense. And at the same time, there are some places in Barcelona where it doesn't make sense.
So on what's 4%. The logic behind how we decide whether it makes sense or not?
Jean, I can tell you one important aspect, which I've been trying to tell to a lot of people that, as obvious as it sounds, a lot of people ignore it, that the investment return that you get, it usually indicates the risk. As simple as that. So basically, if we consider some property in Ramblas, or something, like everything like in the city center of Barcelona, like just you lose a tenant, next month you will have another tenant. So, you have very good vacancy and you also have very good liquidity. So there's a lot of buyers. You don't need to drop the price if you need to cash out. So that's one of the things. But I think that if we are speaking particularly about Barcelona or Spain in general, for a lot of people owning not only a house, but also a rental property, it's an emotional thing. Like people like to own things. They like to touch them. They like to be in them. And, for people, and especially people from the north, Spain is something very active, and people want to be there. They want to spend more time. People think that I'm going to buy an apartment in Barcelona. I will rent it out now. Then when I'll have children, maybe they will study in Barcelona. They'll have a place to stay, I think in general, the Europeans really like to own real estate. Mm-hmm. Although the general economical logic says that renting real estate is cheaper for you than owning it, but people love it, and it's you can't actually blame the people because it's emotional decision. And mm-hmm. If we're gonna look for ROIs and calculate XIRRs in every step of our lives, sometimes the life could get miserable.
Yeah.
So people, it's important, to follow this FIRE idea of, saving money, investing, not spending more than you earn and all of this. But look, like we're all people. We all, enjoy different things, and some things come at higher price. And, some people spend it in this way. It makes them feel happier. And, you can't really put a price point on happiness.
Yes, I've had this argument many times myself. I currently rent. I wouldn't have it any other way. But ultimately, it's not a financial decision. It's just I love to move around even within the city. So it would not make any sense for me, even emotionally, to invest in one property, decorate it and everything, and then have to move it. It would be too painful. So like this, I rent, I can move out in 1 month or less, move to another country, no problem. If I had to settle for 10, 20 years in one place, I would probably buy, irrespective of the financial aspect of it. However, as you correctly pointed out, when you invest in a property, location is very important. And we've also seen in Spain what making that mistake means in the past. And to this day, you can see some ghost cities, not on the scale that there is in China, for example, but there are some smaller scale ghost cities where people had invested with the mistaken idea that property always goes up, the demand never stops. That didn't come true, and they lost all their money, basically. So, good point that you made. And coming back to Lithuania, what you were talking about before I derailed you about with this subject a bit. You were talking about Lithuania, about the yields that you're getting there,
Yeah,
and the types of
and
properties.
I was talking about why today's market is quite tough. Working at InRento, to me and my team. So one aspect, that the prices are increasing and the yields are decreasing. So that's first point and the obvious one. The second point is that there's no secret that we are still relatively new. We don't have a massive user base and we cannot fund large properties. So what it means for us running our operations, if we find a good asset, something for below 300,000 euros, borrowers apply with like really nice properties to acquire them. In most of the cases, we compete against our clients who are on our platform. Not meaning this in exact way that you, Jean, are my investor and I'm bidding on these, or my borrowers bidding on you, but that this type of investor, now during the lockdown, the sort of person has saved up a lot of money. He can apply for funding at the bank and he can acquire them. So this is what makes our job hard today. Then the third one is that, like, I personally prefer commercial premises more over residential. And right now, like we get a lot of applications, but simply there isn't a tenant, or that the tenant has like a decreased price for rent.
And residential.
Residential is different, but the residential problem is that the yields are too low. If I put an investment where people can invest for 4%, no matter how nice the house will be, I don't think people on crowdfunding will get too excited about it. But we are looking at both aspects and we are looking for best deals. So right now, one of our key criteria in our risk scoring is analyzing the tenancy. So basically, is the tenant paying? Is he financially strong? With these residential assets, the project that we are currently funding, it has, I would say, very high interest rate for rental investments. It has 7.36%, I think, which, if you invest in real estate development, you'll get 7% yield. So it's quite high. And what we particularly liked about this asset, there's another element which we still haven't touched down in this our conversation, is that the return on InRento depends on three aspects. So one, the interest rate for financing paid by the borrower. Second, the rental yield. And third one is the capital growth. So if the property would be sold later for a higher price, the difference would be spread between the borrower and the investor. So in the case with this particular project, we looked at the historical data of historical capital appreciation of that district for these type of assets. So historical appreciation over 5 years is 33% over the last 5 years. So, and this district is up and coming. And what's really nice about it is that, all right, it has 6 units, 6 tenants. One walks out, the others stay in. So the risk is minimized on this aspect. The price of the rent is very low. It's now, if I'm not mistaken, it's 250 euros per apartment. It's a studio apartment. It's pretty small, but like even in Lithuania, this is like really, really small amount to pay for rent. If I ask you to go to listing site and find me an apartment for 250 euros, maybe you would find something in old Soviet blocks, but you wouldn't find anything new. This particular property was fully refurbished in 2019, and you're just 15 minutes away from the old town. So what our general belief and analysis has shown that even if the tenant walks in, the other tenant will come in less than 45 days. This is actually what the historical data also suggests, because we, of course, monitor the historical transactions of each asset. So if one tenant walks out, the other one comes in really quick. So this is the deal, that we are currently financing. The previous deals, just to give some context, are also like we finance micro offices, Vilnius Center, prime area, but also same idea, very cheap rent. You don't find those in Vilnius. And even during the lockdown, these are very small units. So when you have freelancers or individuals, who are working not at companies, but anyone, graphic designer, whatever comes to your mind, some of them have families; they cannot work from home, or their home do not provide these availabilities. You can also rent a really, really nice office in Vilnius city center for less than 300 euros. Also, like these prices it's hard to find. So this was our investment philosophy for those two assets. The other asset, what we really liked about the second one that I just told about, 80% LTV. So we like this aspect, that it has 80% LTV. The other aspect which we really liked was when you have such a high, like when you have 80% LTV and you have 20% price difference, in a sense, you can consider that you are getting an instant capital growth. Like if you think from that perspective, and if we look at the historical data, we looked at there were in the same building for very similar properties, the transactions were much higher. So sales transactions. So it was a bargain for the investors from that perspective, and the tenant was good as well. Like we discussed, when we analyze projects, we also try to get in touch with the tenant to understand what is the real situation if we are talking about business tenant during this pandemic period. So, this tenant in particular, what we liked, he had an expiring rental contract with few months left, and he said, like, if the project owner will invest a little bit to fix all the air conditioning systems, we're going to stay there for at least a couple of years. So, to extend for, 2 more years during the pandemic, when, people are working from homes, for such a property, it gives a very good indication about its demand on the market.
Okay, very interesting. And 2 questions we haven't touched upon. Why Lithuania? Why Vilnius? And secondly, do you have any special advantages for securing good properties that, let's say, a knowledgeable person from Vilnius would not have?
So let's talk why Vilnius. First, it's not only Vilnius. Right now, we are looking at all Lithuania. Why in particular Lithuania? It's main reason that this is where we are regulated. This is where we have the license. This is where we are from. This is the market that we know the best. And, during this period of pandemic, it's hard to move around, to be frank. So it makes sense to go local. And it's actually quite a good decision for us to start there, because the market is very active. The real estate prices have been increasing, over time. The economy is growing. Maybe this year it will decrease as, most of the European states, but in general, we have one of the top economies in terms of growth rate in Europe. The fintech market is booming. Vilnius is becoming a full fintech hub, which, is creating thousands of very high paying jobs, which is, naturally impacting the real estate market. So I think that in general, Lithuania is a good place if to grow your net worth if you're thinking to invest, because there was somewhere I found this saying which I really liked, which said, Lithuania, the country which is as ambitious as you are. And I really like this one because it doesn't says it's up to you, how you see it, who you are. This is the country, that's gonna be. So in that respect, I would say that people here are hungry.
I wish Spain was like that.
Spain had its time, and Spain
Yeah,
was like
it
that,
had its
in
time.
16, when you had Christopher Columbus, going to the
That's true.
USA. He was the real entrepreneur at that time. He was a prime example, of the fintechs that we are doing in Vilnius. But
True.
he was just, times have changed. So I think that right now, where we have Lithuania, it's some people still think it's a developing market, but in general, purchasing power parity index is higher than in Spain. And, we don't have Barcelona or Madrid. So I think we are moving in the right direction. And then the second aspect, why we think, why do we have a better advantage than anyone else? So there are a few elements. I think the first one, we come down to the one that we told before, that we have project owners, borrowers. So, we get tens, or like I think now we have received close to 100 applications of real estate. So, those people who are trying to borrow money, they are professionals. They've been in real estate market for years. So, if we add up their input, our input, this is where we come. If we speak from our team and, our ability to assess, real estate investment opportunities, or generally investments, me and our head of investments, we are licensed financial brokers. So we hold a license for MiFID II regulation from Asset Management Association. Our chief risk officer, he's been in real estate for, I think, 30 years, 20 years. If you go to our website, you will see it from his face. He's been in this game for long years.
Yeah.
Asset management, real estate. He's done everything in Lithuania. So from very small houses, he's been property manager of largest Lithuanian shopping malls, where millions of people come every day. He's been managing assets of the nation as well at Turto Bankas, which is a government institution which is responsible for all the properties the country owns and decides whether it's time for them to sell, buy, own it, how to operate it. So I think from that perspective, we have a team which is very diverse, but at the same time, our experience and knowledge overlaps, is that we have a knowledge of fintechs and financial institutions, where, I combine my experience from Evo Estate, analyzing, all those platforms. David, our head of investments, he's worked at companies like RoboMarkets, which is quite known in, investment brokerage firm. Vytautas, our communications person, he's been a former employee at Picera and other fintechs, and then, Ronaldo's, who has done, I think, everything in real estate, whatever the person can come up. So I think that in this perspective, we are a good combination of people with, interest to build new things, build new technologies, and also the experience and low appetite for risk, to basically just control the risk level while creating something new.
Mm-hmm. Very good. Makes sense. And now, for people who have been used to seeing your face on the blog posts of Evo Estate, for example, you've been very involved with that platform. Can you explain what's your, if any, remaining involvement in Evo Estate, and perhaps why you decided to branch off and do InRento? Just to give some context, because it's good for people to know how the two are related, since you've been one of the driving forces behind Evo Estate as well.
So today I'm only indirect shareholder of Evo Estate. So in that regard, I don't do anything, so to say. I trust the team that is there, and I'm not involved in, probably not any way, in their operations. And I think this is in a sense, it's also a good decision, because at first, when we were coming up with InRento, I really thought this is a this is a market opportunity, and also there is a problem on the market that needs to be solved. And I thought this could be like a branch of ours, and we could, hire good people to run it, or have it sort of like on our side. But when we launched it, I was like CEO at both companies, and what I came to realize, the reason why Evo Estate has been liked by so many people around the world was probably one of the reasons that it's independent, and it gives, I would like to say, it's a podcast, so I probably can't say this, no bullshit review of projects, platforms. Like this is what we've been about. This is who we are as people, and we care about this radical transparency. So, and what I came to realize, that probably if I serve at both positions, it's not the best for Evo Estate, and at the same time, it's not bad, not good for me from focus perspective. Because at life, you can focus on very few things if you really want to do them well. And I was thinking for a lot of time, and I just came to a conclusion that probably, being based locally in Lithuania, it's InRento is the place where I should be. Because before, I didn't live in Lithuania for quite some time, and Evo Estate was very international from that perspective. All our team, even today, is spread across European countries. So, it was a project where you have to be international in multiple countries, dealing with different platforms. But the InRento project is local. And I think for quite some time now, it will still remain local. And me being local here is an advantage.
Yeah, makes sense. And just to be very clear, Evo Estate continues to operate as normal, still doing well, still a good place. I would recommend investors check out. So it's not like you're moving on Evo Estate as a project that is over. It's totally not over. It's just that InRento is something different, as you mentioned.
Yeah, and in fact, adding on this point, I think that Evo Estate is not, doing well. It's actually continuing to grow, which I think is very interesting and also important. And at the same time, for me, as being, starting something new, a little bit jealous.
Challenge.
Yeah, challenge, jealous. It's like it's growing, and Evo Estate with Audrius in charge, it has very big plans. I'm not going to spoil them here, but I think that people will be aware, and there are many good things that are going to happen on the marketplace and generally for the company. So I think there are very exciting things to be waiting for.
Mm-hmm. And should we expect these properties of InRento to also be present on Evo Estate?
Yes. So InRento will continue to list its projects on Evo Estate. I think that for some investors, like for those especially who already have an account on Evo Estate, it probably makes more sense for them to invest via Evo Estate. Those who don't have, I invite you to check out both platforms. I think that today for us, the biggest problem that we have right now is that, it's sort of like a problem, but at the same time, it has extra layer of security, is that in order to invest via InRento, we ask you to open a bank account that we serve. So meaning that when you have this bank account, the money is initiated directly to the investment too. So basically the project owner gets money directly from you. So naturally this takes some time, and for some people it's quite annoying, to open this account. So understanding this, I think Evo Estate could be an easier option if you want to get started. But either way, I highly recommend you to check out both. When it comes to InRento, we are going to fix this problem very soon. So we're going to have some other wallet options where basically people will be able to basically invest a little bit easier, and the process will not be that troublesome.
On this topic of giving the money directly to the borrower, so I've had some chats with other platforms, and this might not apply in your case, but I'm going to ask you anyway. Some platforms have told me that they prefer taking the money themselves first, because then they can release the money gradually based on milestones that the borrower has to accomplish. And this makes a lot of sense with development. In this case, is this something that makes sense for you or not really?
I was like, to be very precise in how it works is that when you press the button of invest in InRento, your money is not being moved anywhere. Your money still is in your bank account, but it's being reserved. So you cannot spend the money temporarily. If the project is successful, it's funded, it still keeps reserved. And only when the borrower completes the necessary security measures, so in our case, placing a mortgage or issuing some sort of guarantees, only then the money is being forwarded to the transit account, which is being owned and operated by Paysera itself. So it's like an escrow account. And then the money is channeled to the borrower. So only when the security is made in place, the investments have guarantees, only then the investments are being channeled. So that's how it works. If the project is also not funded, the reservation is canceled, the money is free to spend in your account.
Makes more sense, yeah. And what is the business model for InRento? And do you have skin in the game in these projects? I know that was a big thing on Evo Estate, for example.
Yeah. So, if I invested in other platforms projects, probably it makes, there's no question whether I would invest in my own platform. So naturally, the answer is yes. The business model of InRento is like most of the crowdfunding platforms. It's a financing business where we charge the borrower a fee for our services. So so to invest on InRento is completely free. It's free, it costs you nothing, and the borrower pays the fee for the financing received.
Okay, and I guess your alignment with the investor is through the skin in the game, right? Because for other platforms, one might say that, yeah, who cares? They just finance the project, get their own fee, and whatever happens, happens. But in this case, yeah.
I think, when we created this model, what we came to realize generally from what I understood from my previous experience is that skin in the game really helps, but most importantly, that the interests of everyone would be aligned. So when I said that, yeah, we earn money from financing the property, we also have a second part where we may earn money in the future is from capital growth. So basically, when we have the spread from the capital growth, it's being spread between us, the investors, and the borrower. So in that regard, we are all in the same boat, so to say. And we all need the property to be sold more expensive that we would earn as well. But I think if we look a little bit deeper into our business model, we have to understand that the rental yield that the investor is receiving is based on revenue sharing, meaning that the project has to be doing well in order that one would earn. So if the investors are earning, the borrowers are earning, everyone is happy. If the project is not rented out, it's not making money, investor is not happy in that case. And this is the situation what you have in most of the buy-to-let crowdfunding platforms across all world. But what we do in InRento is that we force the borrower to pay fixed interest. So basically, when the property is vacant, the investor still generates some return, but in the short term, for 3 months, its interest is pretty small, and it's more as an urgency notice to the borrower to go and find the tenant as soon as possible. But if he doesn't find in this 3 months period, then this fixed interest becomes increasing and increasing, that the investor would get the returns he had expected for. So in rental model only works if everyone's interests are aligned. If one doesn't earn money, then the other one also is not earning money, so it doesn't really make sense. Mm-hmm. So we try to we create a model where the sort of like alignment of interest is unbiased and everyone has to be in the same position.
Makes sense. And coming back to the capital growth that you mentioned, do you have any specific exit period where you plan to sell the properties within X amount of years? And tied into that, I also see that you have a secondary market where investors can liquidate their part if they need to. But I was interested if you have a specific timelines as well for each project.
So, each project is individual. Each project owner is individual. So we discuss different timelines for each project. So far, we've been financing projects for up to 7 years. So basically, this is the maximum time frame, which, in a sense, if you think about it, makes a lot of sense because it's usually a one rental window where you basically acquire the asset, rent, and you still don't need to make a massive renovation, for it to generate cash. So this is the period that the investors the project owner must sell the asset. But he can also sell earlier. There is a minimum time frame, which is also indicated in each project. If borrower violates it, he pays penalties. What it means for the investors, more interest. So good news if that happens. But I think that, everyone, the project owners ourselves, no one at one time, yes, if we won't look from one side, yes, the investment is more long-term. But at the same time, nobody wants to keep it forever. Meaning that if there is a good deal, if there's a good offer to sell the property for profit, why not? Sell the property, make profit, distribute it, finance more deals, make more profit. Probably that's the whole sense of the investment.
Mm-hmm. Makes sense. Yeah, we mentioned briefly, and basically I've asked all the questions that I had, but I think in the beginning we mentioned also the seed round that you made, but we didn't really talk about it. So I think perhaps as a part of wrapping up, it would be good to talk about that additional piece of validation that you've recently got.
We raised our first external funding round. So we have raised it from a couple of business angels and startup wise guys. So for us, it's money always helps. Money always helps to grow business, but at the same time, it's great to have someone experienced who supports your idea. And, these are institutional investors. They know what they're doing. And it's great to have them on board. I believe that, their resources, both capital resources and intellectual resources, will contribute to making our platform better. And, we want to go abroad as soon as possible. But at the same time, we want to see how, the situation works out with the pandemic and how things are progressing.
Yeah, makes sense. Unless you have any other things you wanted to share with us. Just as a conclusion from my end, I'm really excited about this. I'm not involved in it, but I'm excited as an investor, on these platforms. I think the website itself is brilliant, really easy to understand what you do. I've been to Lithuania. I like the place, so I've got a little connection with Lithuania. And I know you for around 2 years now. I know how ambitious and knowledgeable you are. And I feel good about this platform and the kind of risk model that you chose, because I've been burned on the higher risk models, and I've come to prefer these kind of models where I can just rest at ease and maybe risk in different kinds of asset classes. So congratulations on what you've done so far here.
Thank you, John. Thank you.
Thanks again for joining us. So that's a wrap for this episode. Hope you enjoyed it as much as we did. And as usual, I ask you to leave a 5-star review on iTunes if you like the show and all the other shows we've produced so far. Please let us know if there's any other topic that you'd like us to tackle or platform to review. We're very open for hearing from you, your opinions, whether you like the shows we're producing. And yeah, just if you've been listening to this show for the past few episodes, or it's the first episode that you listen, we'd really, really appreciate if you could even just get in touch and tell us how you're finding it, what you'd like us to improve, and things like that. So the email is podcast@mastermind.fm. Again, podcast@mastermind.fm. And you can also find us on Twitter @mastermindfm. That's it for today from us, and see you in the next episode.